Unemployment claims skyrocketed in the United States as they climbed from about 300,000 last week to over 3 million this week. Typically, that would be perceived as awfully terrible news, but of course, some of that has been baked into the disastrous trading of the stock market. So today, we actually had a nice response to that number, and the stock market rose by over 6%, which generally is kind of one of those once-in-a-decade types of moves, but in this case, it was actually just the highest one-day move since Tuesday. In fact, the 3-day move that we've had in the stock market is the greatest 3-day move since the 1930s. So quite the dramatic amount of events that we've all been going through here in the month of March. So we'll take a look at all of that and kind of see how that affects our posture, if at all. And I also wanted to take a look at a company in the travel and leisure space that, of course, is going to be disrupted during this time as our trade application example at the end of tonight's video. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 26th, 2020. First of all, if you're new, be sure to go over to YouTube, click subscribe on our channel. Also go to our description area and sign up for our email distribution list, so that way you can be notified anytime we post these videos, and also gives you a heads up on what stocks in the S&P 500 are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. Both David and I have been more active than normal here in recent weeks as a result of all the market turmoil. So if you want to stay on top of what our thoughts are and what news stories kind of impact our thinking, we would encourage you to follow us. My handle is @BrandonVanZee. And then lastly, we have a presence on Facebook as well, and I would encourage you to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts. And as you can see here, I've got chart 6D pulled up here yet again. I say yet again because it's been kind of regular in the month of March that we've had very erratic price movements. Generally, I bring this chart up anytime we move more than 1%, which has been nearly every single day in recent weeks. So here we are again with this nice towering green bar, and we were up 6.24% in the S&P 500 today. And as I mentioned in the intro, normally that would be one of the biggest days in a decade, but in this case, it was actually just the biggest day since 2 days ago. On Tuesday, we had another sharp rally there of about 9% in that case. So combined with that 9% along with the 6% we got today, and then another 1% that you tacked on yesterday, that's where you got that 3-day rally that is the greatest the stock market has seen since the 1930s. Quite dramatic. Now, one thing I did want to point out, some of you on Twitter have been kind of following along with David and I's commentary there regarding what's been going on with the VIX, and kind of a suspicious head scratcher there is that the VIX is really holding its own. The VIX, even after this massive 3-day rally, is still hanging out right around 60. And that is, of course, historically elevated levels there. And so it kind of gives you some insight as to the possibility that professional traders think that we still have a little bit of work to do before the bottom of this market can be called. And that is kind of my mindset right now as well. I tend to think this is more of a dead cat bounce. How far it goes up in the meantime is anybody's guess, but I'm not one that right now is assuming this will be a V-shaped recovery. Then again, as time goes on and new information is presented, not only in the news, but also just from a price and volume perspective, if my attitude towards that needs to change, I'll be happy to do so. And I'll also submit to you that from a personal perspective, I'd love for this to be a V-shaped recovery with all the stocks that I own. I would be I would be in the streets and the first one leading the parade. But the reality of the situation is that there was a lot of damage done to the charts in the last month. And we probably need some time in the penalty box. And while we have taken some sharp blows from a price perspective, I just don't know if we've caused enough pain from a time perspective yet. It's possible that we go sideways or meander a little bit lower for the next few months, just aggravating investors over that time period. So we have to keep our mind open to that possibility. I know it's easy to get carried away with the amazing gains that the markets have had here in the last 3 days, but remember that there will be bag holders at the end of the move whenever that is to occur. And given how sharply stocks have been moving, if you're a bag holder in the wrong stock, you could find yourself down 20 or 25% in a week, whereas typically that would be a very terrible outcome in an entire year. So these are more difficult moments that a lot of people are struggling through right now. If it's kind of scaring you away from trading to a degree, remember, you don't always have to be in and out and timing every market move perfectly. Maybe this is an opportunity for you to look for what were attractive businesses that you had wished you'd owned over the years, yet you had thought they were a little bit too expensive. One of the things I was sharing on Twitter with one of our Market Scholars members today was, the nice thing about this particular pullback as opposed to what we experienced in 2008 and then also back in the year 2000 is that commissions are largely free now. And I know you probably don't feel like the big man or the big woman on campus when you're buying a couple of shares here and a couple of shares there. But the benefit of no commissions is you can get away with that now without feeling like it's too disruptive to your overall trading results. Put a couple $100 to work here, and if it falls further, you just keep on buying as long as you're comfortable with the idea that particular stock would be one that is going to be able to make it through whatever storm clouds we're about to go through here with the coronavirus. So, there's a lot of big name companies in the Dow Jones Industrial Average that I'm sure have been on your radar over the years. And when you have a disruptive market like this, where many of those fine quality companies are down 30 or 40%, why not grab a couple of shares? That way you got one foot in the door. If the market does have kind of a nasty reversal lower from here, then you can continue to buy more shares lower. On the other hand, if the market does rally strongly from this level and it is more of a V-shaped recovery, at least you were able to take advantage of it sparingly along the way with a little bit of exposure. So, of course, David and I are not here to give you direct advice. That's not our job, but just kind of spitballing ideas for those of you that kind of feel like you've been stuck in a tornado of activity where maybe you feel like you've always been on the wrong side of it. Right when you buy is when you should have been selling, and right when you sell is when the market is about to rip higher. So I've been there myself. I know how that feels, and it can be a little bit aggravating. So do your best in a market environment like this. Try to stick with high quality and try to pick up a few shares when they go on sale. And for the vast majority of the stock market, it has been on sale for the last month. So anyway, when I wanted to show you here over on the visualize area of the Market Watch tab as well that the S&P 500 had another very aggressive day for the bulls. Now remember, on Tuesday when I was with you in this video, there were only 11 stocks in the S&P 500 that were down that day. Today there were a few more. There were 32, but still that is an awfully one-sided market there. This was a very robust rally for a lot of your bulls out there. So once again, that's helping that process of establishing a new range for prices. If you think that the bulls are going to be able to kind of maintain or hold these lows that we've had here recently, that's a good sign. You want to see days like we had Tuesday and today. Some of those areas that were declining are kind of some of those more travel and leisure types of stocks, and we'll talk about one of those at the end of tonight's video. Let's go ahead and get along with things here on the charts. I know it's getting later, and as a reminder, my schedule's a little bit different, and it will be up until May as a result of our schools here being shut down. I do have to wait for my wife to get home from her job before I can start these Market Outlook videos, whereas in the past I had tried to get them to you a few hours earlier than I am able to now, and that's why you don't see the camera either. I figured I better hurry up and get the video done as soon as I can and worry about showering later. So we'll leave it at that, but for the next month or so, the videos won't have my camera on them, and they'll be a little bit later than normal as a result of all the personal inconveniences that all of us in this country seem to be going through right now as a result of the coronavirus. So I do appreciate your patience along the way, but hopefully we can still get you some good content regardless. Let's go ahead and take a look here at our chart 4B. And this is our 4 grid to look at the 4 major U.S. equity indices side by side. And if you were to tell somebody that the stock market was going to go through its biggest 3-day rally since the 1930s, I think most of the time the assumption would be you have to be in a bullish posture market for that to occur. And as you can see, despite the amazing rip higher we've had in 3 days, all 4 of our charts remain bearish. We're getting closer to potentially switching over to weekly bullish, but at this point they are still all strongly bearish. How I know that so quickly, in case some of you are newer to these videos, remember the background color of the chart here on chart 4B is going to tell you whether we have a bullish or bearish posture using the market forecast technical indicator, and for that we are using the intermediate line. So the dark pink background like we have there, there, and there are telling us that we have strongly bearish postures. And what's being measured there is this green line on the market forecast indicator down below the price candles themselves. So you can see that my point that I was making on Tuesday still holds true right now, which is at this point, I do believe that it'll be the NASDAQ that does go bullish first. If that is to occur, that could happen as soon as tomorrow. And of course, if that does occur, David will be happy to share that with you when he does the video. But remember that that intermediate line needs to go above 20 in order for us to have a weekly bullish posture. Anything below 20, which is the lower reversal zone on the market forecast indicator, is considered to be strongly bearish. So the NASDAQ at 19.53 could easily get there tomorrow. In fact, the Dow Jones is kind of having a surprise emergence here. Most of you that are watching the financial markets news recently are well aware of the reason behind that. Boeing has gone up 90% this week. I know that that sounds like I'm an inaccurate statement. How could Boeing possibly be up 90% in 1 week? Well, it's true. When you have a stock that got bludgeoned the way that Boeing was in the prior weeks, then the rebounds higher can be even stronger. So with Boeing being one of the most important components in the Dow Jones Industrial Average due to its above average price, because Boeing is about $180 stock, the Dow Jones is a price-weighted index, and so Boeing carries a lot more weight in the Dow Jones than it does in other indices. So if you would have looked at the Dow Jones at the beginning of the week, its green line on the market forecast would have been a little bit lower, but it has surged so much this week as a result of it getting an above average boost from Boeing there. So anyway, I would expect the NASDAQ to give us a weekly bullish posture tomorrow unless something disastrous happens. And remember, it is expected that the stimulus bill will be signed tomorrow. Whether the stock market likes that or not, or whether it's already baked into the cake, is anybody's guess. But if for some reason politicians start arguing with one another and the bill doesn't get signed, maybe that would be a reason why the stock market would completely fall apart. But unless that happens, then my assumption right now is that the NASDAQ composite will end up with a weekly bullish posture starting tomorrow. Now, even if that does happen, keep in mind, it's not like it's roses for the NASDAQ going forward. It's just saying that it has been able to withstand the storm a bit better than those other areas, especially with stocks like Apple and Microsoft doing a little bit better there. But anyway, remember that even if we get a weekly bullish posture tomorrow, we'll still likely be below a falling 30-day moving average. So the path of least resistance continues to be to the downside, even if there are a few more intermediate trends starting to emerge there. So across the board, it was a beautiful day. If you're a bull, up 6% plus in all 4 of these. Actually, I take that back. The NASDAQ was up 5.6%. So if you round it up, I guess you could say it was 6% moves across the board for all of these key indices here. A very nice day. Let's go ahead and take a look at our 3 green arrows chart. Hang on a sec. Sorry about that. I've been really battling through this cough lately. I'll do my best not to cough into the microphone here. Where was I? Three green arrows. Three green arrows. Three green arrows chart is actually starting to brighten, have some brightening prospects here, where you've got the MACD turning green on on all four of our charts here. So that's a positive sign. Remember, the MACD measures momentum. And with the surge that we've had in the last 3 days, we've certainly had a bit of positive momentum there. But until we can start trading above those moving averages, we won't be able to get those three green arrows kicked into place. So right now, notice that on chart 4D here, we've got empty colored backgrounds, or white colored backgrounds, however you want to say that. So it basically means we have a mix of green and red arrows. We've got green arrows on the MACD on all four of our charts, and we do have green arrows on the stochastics for the NASDAQ composite and the Dow Jones Industrial Average, but we still have red arrows across the board on our 30-day moving averages on all four of our charts. So we've got work to do is the main point there. And again, that's kind of why my philosophy right now is that this is still a bull rally within a bear market is my assumption right now, and that this will eventually reverse course, and that we will need to go and test some of those lows that we experienced here over the past week or so. All right, let's go ahead and check out some 12 grid analysis now, starting with 5A. And this is going to take a look at some of those key asset classes out there. One of the things that's been catching some traders' eyes this week is that the US dollar has been falling this week. That has been maybe supporting the stock market. Remember that while it's nice for us that live in the United States when we want to travel to have a really strong dollar, that way we can buy more goods and services abroad with our strong dollar. The truth of the matter is, typically stock investors want a weak dollar. And you think about some of the giants of the world out there, whether you're talking about Apple or Cisco or Procter & Gamble, you think of these big giant companies, and most of them do more business outside of the U.S. than they do inside of the U.S. So in a way, while it may sound like you're being anti-patriotic by saying you want a weak dollar, that's effectively what you do want if you want stock prices to be rising. So that, I think, has been part of the story as to why we've been able to rally as strongly as we have, is that the U.S. dollar has been sinking for the last 5 days. And remember, a week ago, that there was that concern that we were just going straight up the pole there on the U.S. dollar at the time when the stock market was really struggling. Now that the dollar has come back in, the stock market itself has been allowed an opportunity to bounce a little bit here. So you can see that the foreign stock markets continue to have a bearish posture like the U.S. markets do. So EFA, which is your developed foreign markets, are right here. It was a pretty nice rally out of them today, 4.47% to the upside. And then EEM is right here. It wasn't quite as aggressive of a move, only up 3.79%, but again shares that commonality there where we do have bearish postures on all of our key equity indices across the globe right now, despite the very strong rally that we've seen. Other things to be aware of is that the gold trade that I had mentioned on Tuesday was working again today. It was up 1.28%. However, there was a down day yesterday in between, so that one wasn't as impressive as what we're seeing just in the stock market itself, or at least not as consistent. However, I still tend to think that we're kind of in a more normalized range here for gold, and I do have an interest in gold as an upside play from these levels, even if I think that the stock market itself is going to retest lows. I do think that gold kind of got caught up in a dislocated market here in the last couple of weeks, where there were a lot of margin calls out there, and a lot of people were just liquidating anything of value, including gold. That's my assumption. I could be wrong on that, but I tend to think that from this level forward, gold stands a better opportunity to stay in a somewhat strong position here even though it was falling with the stock market last week. I tend to think that gold is going to be able to hold these levels, maybe not surge from here, but at least maintain or retain value here, even if I think that the stock markets themselves will have to roll over here in the coming weeks and months. So keep your eye on gold. It seems to be one of those areas that has some interest at these particular levels. Let's go ahead and now take a look at the 5C, which is the 12 grids for the U.S. sectors. We had something very interesting happening today, which is all sectors had a really stellar day. All of them were up more than 4%. So a really strong rally across the board. Now we were led higher today by the utilities, which is a bit peculiar. You can see that the utilities were up 8%. Now, somewhat selfishly, I don't mind seeing that because just Tuesday, as I mentioned to you in the Market Outlook video, earlier in that day, I teach a weekly dividend growth investing class where we look for opportunities amongst the rubble. And fortunately, our head-to-head matchup that day was with the utilities, and the utility stock that we had purchased is already up double-digit percentages since then. So, so far, so good. We'll see how long that lasts, but in a way, I'm happy about it for the class's perspective. However, what I will say about the utilities, quote unquote, leading today is it doesn't really give us any warm and fuzzy feelings about the market at large. Typically, you don't want to see the utilities as your leading sector if you are thinking that the stock market itself is going to have this massive move higher from these levels. So it was a little bit suspicious to see such a highly defensive group like the utilities leading here, and might be another reason why you remain a bit skeptical about the stock market's prospects in the immediate future going higher. And I think it just puts another feather in the cap of those that think that there is going to be a retest of the lows at some point going forward. Where that happens, does it start tomorrow? Does it start next week? What we have been seeing in most Friday sessions in the last month or so is that investors have largely not wanted to hold stocks into the weekend. With this coronavirus news seemingly getting worse every day. Just today we found the news that the United States is now, it has the most cases worldwide. So obviously we have a larger population than places like, Italy or Spain. But nonetheless, it's kind of an eye-opener to think we're kind of at the epicenter of this whole thing right now. And of course, the United States' economy has been renowned as one of the most important around the globe for decades. And so we're battling this invisible enemy, as the president would say, here on our shores right now. And our economy is grappling with, what are the potential outcomes of that? And we hear interesting side stories on a regular basis. One of the things I was tweeting about here in the last day or so is that Cheesecake Factory, which is a very popular restaurant here in the United States, has basically told its landlords that it's not paying rent and it's asking for help. So normally you would not expect that, 1 month after what had been one of the strongest economies that most of us have ever experienced. But just like that, things have changed dramatically, where people are not going to restaurants the way that they were in the past, and they're not going to movie theaters, or they're not going to sporting events. And, we're still grappling with what is the potential outcome of this new way of life that we are all kind of going through in real time right here. So, I think there's still going to be a lot of back and forth tug of war between the bulls and the bears, and we're not just going to experience a one-sided up rip higher for the stock market back to all-time highs. Could I be wrong? Of course. But right now, my baseline assumption is that is not going to occur, and that we're going to have to kind of slosh through this ugliness going forward. But in the meantime, at least we're starting to see some green shoots appearing here and there, and it is nice to see green background color on technology, discretionary, and utilities right now, because a week ago we would have had nothing but pink charts here. So slowly but surely, with this rally that we've seen, while we haven't been able to change the S&P 500's posture back to bullish yet, at least we do have 3 out of our 11 sectors that are carrying their weight, for those of you that are hoping that eventually takes place. So With that, let me go ahead and get into our trade application example tonight, so that way I can get this video uploaded and get it to at least most of you before nighttime. I know those of you out east might not be able to get this until the morning, but nonetheless, sooner we can get this done, the sooner we can get it uploaded. So let me get into our trade application example here tonight. And for that, let's just go to maybe... how about we do our swing trading chart, 3A? And I wanted to take a look at a stock that had a little bit more of a bearish feel to it today, and that's Wynn Resorts. So as you can see here, Wynn Resorts was a $153 stock back here in January. Well before we had any idea of the destruction of the coronavirus, at least here in the United States. Now remember, Wynn is not just a domestic operator. Most people that have been to Vegas are familiar with Wynn Resorts, but I can tell you firsthand that that Wynn actually has properties in Macau as well. My brother and I took a trip there once upon a time, and actually was at the Wynn Resort there in Macau. So they do have foreign exposure, but what I wonder is whether people in general, I do know that, the reports suggest that over in China, they're past the coronavirus. They haven't been reporting any new cases, and life is slowly getting back to normal over there, which I applaud. That's wonderful. I hope that gives us, something to look forward to here in the United States. Yet I do wonder what the psychology of the typical person is in China or anywhere after such a major health scare like we've had. And I do wonder if people will be a little bit less enthusiastic about going to casinos and resorts and things like that, even if the health professionals say that we're past the epidemic. And so while we've had a nice rally from Wynn shares here from about $35 or $36 a couple of weeks ago to where we're at right now at 71. I know it doesn't look like a whole lot on the chart, but it's actually a really aggressive move. We doubled off of the lows just a week and a half ago. Now today, you can see that we actually finished lower. So when I was telling you about, there were only 30 plus stocks in the S&P 500 that finished lower today on such an aggressive up day for the market, this is one of them. And they weren't alone. There were a number of other travel and leisure related names that finished lower here today, despite all this news about how the government is going to be supporting the travel and leisure industry stocks. So that might be a little bit of a clue that the reflex rally has run its course. Now this one's somewhat similar to the trade that I showed you 2 nights ago that we were talking about on Twitter a little bit today, which was Roku, which had kind of stalled out just a little bit below that falling moving average. Now, we got kind of lucky on this one because the stock market has rallied furiously in the last 2 days, yet our bearish trade on Roku has been doing quite well. It's continued to roll over here. And I'm hoping that maybe Wynn will be able to treat us equally as kindly. You can see that the candle today is a little bit different than what I explained with Roku a couple of nights ago. With Roku, it was more of a doji formation where we had more of a, it was anybody's guess as to whether it would roll over or not. I had my suspicion that it might, but it's a sign of indecision when you're looking at more of a doji or a spinning top type of a candle. This one is actually a little bit more aggressive bearish here. You can see here that this would be kind of known as a bearish engulfing candle here if you're looking just at the bodies. I know that some people might look at the wicks, but if you're looking purely at the bodies, that would be a bearish engulfing candle that we have here, along with the blue line falling out of the upper reversal zone. That's your near-term line on the market forecast indicator. That's the line that we tend to use with our swing trades a little bit more often. And so you can see that the background color of the chart went from blue to pink here just today as a result of that bearish trading activity that took place there on Wynn. So this is a rare example of a stock that actually gave you a bearish swing trading posture on a day when the entire stock market was up 6% in a day. So there's not a whole lot of companies out there that can probably make that claim. So what I thought we would do here today is set up another options trade, and it's similar to the trade that I did the other night on Roku. This is known as a bear call spread, and the nice thing about doing bear call spreads is you don't have to be perfect with your entry. You just have to be reasonably correct from a directional perspective. In other words, we're giving ourselves wiggle room to be wrong here. We're not just going out there and saying, yep, 71.51, that's the top, and now it's going to go straight down. We're giving ourselves some ability to weather a little bit more of a storm higher if that is what is to occur, but yet still have ample enough rewards to consider the possibility of this trade. Typically what we're shooting for is a 30% return on risk when we're doing these bear call spreads. You can see what I've selected here is the April contracts. These are the monthly contracts. And I've sold the $90 call as our sold strike, and I've bought the $92.50 call as our bought strike. So because the sold strike is worth more than the bought strike, that creates a credit. So in this particular case, we're doing a $2.50 wide spread, and we're receiving 57 cents of credit in order to do that. Now, for those of you that have never calculated a return on risk before, we tend to want to get about a 30% return on risk, and an easy way to do that is just simply click confirm and send once. That will load up the trade information, and it'll tell you what's your max profit and also what's your max loss. So then once you have those numbers, just get your calculator out, take 57 in this case, $57 max gain, divide that by max loss of 193, and right there you can see that it's a 29.5% return on risk, or in other words, if you round up, a 30% return on risk. So I'm going to go ahead and click send there and send that in, but also take note of what your break even is on this trade, which is $90.57. So I'm going to click on send, and then we'll come back on over here to the chart, and $90.57 is approximately, can't get my mouse right on it, but it's right around there. So you can see that it would allow you that wiggle room for the stock to go up a bit more. What you're really, focusing on if you're looking for a bogey for your eye is look at this candle over here. The high on that candle was $90.38. So if you think that that is representative of an important kind of resistance area, then this is a trade that could work out to your advantage. It is also my expectation that this moving average will continue to come down, and although it's not currently below $90, that I think that as the weeks roll on, it's going to continue to drift lower, and it will likely go below $90.57 at some point in the coming weeks as well. So that could also represent a resistance area for those of you that are kind of looking for one last stand out of the bears to be selling, just in case this doesn't reverse course right here. But I actually think it has a decent chance of reversing course right here as a result of that bearish engulfing candle that I mentioned. It's just that I want to play it a little bit safer because this is a wild stock market that we're in, and you just never know what new stimulus bill is going to be announced tomorrow, and then the stock market's up another 5%. So I'm just being a little bit more cautious as a result of the uncharacteristically volatile markets that we find ourselves in right now. For those of you that want to be a little bit more aggressive, maybe you do a long put spread, or maybe you just short the stock outright. Those are areas where you could get more upside profit potential. It's just that you're taking on a little bit more risk with that as well. Okay. All right. Well, thank you for joining me here yet again tonight. It was a great day for those of you that were long stocks. Another 6% move today, part of one of the greatest 3-day stretches in the history of the stock market. But it still is leading us to the exact same place that we were previously, which is we still have bearish postures on the overall markets themselves. And right now the assumption is this is just a dead cat bounce, but we'll be willing to take a look at that information. If it changes, we'll be happy to change along with it. And that's the beauty of technical analysis. So with that, I want to wish you all the best of success with your trades and your investments. And remember, tomorrow I'll be doing my options for long-term investors class at 10 a.m. Eastern Time, and then David will have his technical analysis trading room at 1 p.m. Eastern time. So a slight schedule change there as a result of our personal schedules changing because of school's out for our kids. So be aware of that. And that's all updated for those of you that are Premium and Plus members on our calendar. So we look forward to seeing many of you in our classes tomorrow. And then David will be back with you with the Market Outlook video tomorrow afternoon. All right, with that, I want to wish you all the best of success. Take care, everybody. Bye-bye.